Hi, welcome to Dig into China. I'm Dong Shong. Last week, China's central bank made a bold move showing clear determination to drive GDP growth above 5% this year. This time, they took major steps, starting with a significant reserve requirement ratio cut. Typically, reduction have been 0.25%, but this time they slashed it by 0.5% in one go. Additionally, they signaled that further cuts could be made in the fourth quarter if needed. In essence, the central bank is committed to ensuring ample liquidity for the market. Next is the interest rate cut, with the 7-day reserve repo rate reduced by 20 basis points. The long prime rate LPR is also expected to drop by at least 20 basis points next month. Additionally, the central bank announced a 0.5 percentage point reduction in mortgage rates for existing loans, providing further relief to borrowers. The final and most significant measure, which triggered a surge in the A-shares market that day, and the only one not leaked beforehand, was the central bank's introduction of a new monetary policy tool aimed at supporting the stock market's rise. Going forward, financial institutions can directly pledge stocks to the central bank, with the central bank itself stepping in to prop up the A-share market, an impressive move. Central Bank Governor Pan Gongsheng even mentioned that a stabilization fund is being considered. It's evident that the central bank is unleashing every possible advantage, determined to push up the A-shares. By introducing so many favorable policies and personally backing the market, the central bank is funneling targeted funds to support its rise. Do these measures genuinely have the potential to lift China's economy out of the slump, or are they merely temporary boosts to inflate this year's GDP growth? Today, I'll explore the possible short and long-term effects of the central bank's bold actions. The new monetary policy tools that the central bank just established for the Asia markets mainly consist of two key measures. The first measure allows security funds and insurance companies to exchange assets more conveniently. It enables qualified security funds and insurance companies to use their own bond ETFs and the stocks from the CSI 300 index as collateral to obtain highly liquid assets like government bonds and the central bank's bills from the central bank. However, there is a restriction. The liquidity obtained from the central bank can only be used for investments in the stock market. In the initial phase, the central bank will provide 500 billion yuan, meaning that brokers, funds, and insurance companies can leverage their stocks to borrow money directly from the central bank and reinvest those funds in the stock market. This will enhance liquidity in the A-share market, particularly for the national team. In the past, the national team, Central Huijin, borrowed short-term loans from banks and has already racked up hundreds of billions in debt this year. Now, with the ability to pledge stocks directly to the central bank for liquidity, the national team will have a steady supply of funding. For example, if Central Huijin has 1 billion yuan worth of ICBC shares, they can pledge these stocks to the central bank. If the central bank agreed to exchange them for 800 million yuan in central bank bills, Central Huijin can then cash in these 800 million yuan in bills to buy more ICBC shares. Afterward, they can take the new shares and go back to the central bank to exchange them for additional bills. Of course, the 800 million yuan exchange rate is just my estimate, as borrowing from the central bank usually involves fewer restrictions compared to commercial banks. Commercial banks face limitations related to profitability and scale, and their capital adequacy ratios cap the amount they can lend. Furthermore, there are numerous risk control and compliance requirements, which can complicate the borrowing process from banks. In contrast, the central bank operates differently. It isn't profit-driven and can adjust the size of its funding pool. Thus, borrowing directly from the central bank offers lower interest rates and larger sums, making it a very favorable option. It's fair to say that the national team was overjoyed when the central bank rolled out this policy tool, as they no longer need to request funds from the Treasury. They now have plenty of resources at their disposal. This allows them to drive the A-shares market as high as they desire. The central bank has stated it will provide an initial 500 billion yuan, and if the results are promising, they could allocate another 500 billion or even up to 1 trillion yuan. There's simply no concern about funding. The other new tools is the stock repurchase and the shareholding enhancement loans. What does this mean? It allows commercial banks to lend money to listed companies and major shareholders specifically for the purpose of repurchasing or increasing their holdings in the company's stock. For each loan that the commercial banks issue under this scheme, they can apply to the central bank for a re-lending facility with an initial limit of 300 billion yuan. The relending rate from the central bank is set at 1.75%, while the rate for loans to client is 2.25%, allowing banks to earn a net profit of 0.5%. Essentially, banks serve as intermediaries, borrowing from the central bank and lending to listed companies and major shareholders to capture the interest spread. The central bank has also stated that if demand is high, it can increase the 300 billion yuan cap. This measure effectively encourages listed companies and major shareholders to actively buy back their own stocks, while also providing liquidity support for the A-share market. Going forward, institutions can easily borrow money directly from the central bank, and the listed companies and the major shareholders can secure loans from commercial banks with minimal requirements. The borrowing process is simple, and the interest rates are quite attractive. In short, the central bank is promoting stock trading. As long as you are purchasing stocks, financing will not be a concern. The central bank managed this major announcement with impressive confidentiality. The earlier reports from Bloomberg didn't mention this measure at all. And when the A-shares market opened on the day of the announcement, it started off quietly before experiencing a sharp surge once the news was released. This suggests that no one had insider information to prepare in advance. I believe this might be the central bank showcasing its commitment. In the past, central bank data and policy announcements often seemed to be leaked in advance, with the stock market reacting ahead of time. However, this time the information was tightly controlled, perhaps because investor sentiment around A-shares has been negative for so long. Without the restoring confidence among retail investors, it will be hard to attract more participants to the market. This brings us to the China Securities Regulatory Commission, CSRC. Since hardliner Wu Qing took charge, the CSRC has been showcasing a firm stance, issuing fines non-stop. However, this hasn't been enough to restore investor confidence in A-shares. Now, with the central bank's new policy tools in place, the CSRC can finally implement the genuine market value management for listed companies. Simply put, the CSRC's market value management encourages companies to focus more on shareholder returns, potentially boosting dividends. Meanwhile, the central bank's tool motivates major shareholders to take loans for stock buybacks and allow institutions to invest more in the stock market without worrying about the liquidity. In essence, this creates artificial arbitrage opportunities. Let me illustrate with an example. Suppose Central Huijin holds a significant amount of bank stocks, say 1 billion yuan worth of ICBC shares, which pays a 5% annual dividend. If Central Huijin pledges these stocks to the central bank and borrows at a 2.5% interest rate, they would effectively gain a 2.5% profit margin. This would give Central Huijin a strong incentive to continuously borrow from the central bank, as they could consistently earn from the interest spread each year. The same principle applies to major shareholders of listed companies. If they receive annual dividends above 3%, but can secure stock repurchase loans at a rate of just 2.25%, they would be earning an easy profit margin. This creates a strong incentive for shareholders to take out the loans and engage in arbitrage, which in turn drives up stock prices. This is the core goal of the CSRC's market value management. It can only be achieved with the central bank's coordinated liquidity support and policy tools. To be honest, if a company has to rely on stock buybacks to boost its share price, it's quite an awkward position. In the US, the government discourages companies from using profits primarily for buybacks. They'd rather see business invest in growth, create jobs, and funnel money into the real economy. That's why the Biden administration imposed a 1% tax on stock buybacks, with plans to increase it to 4%. But the Chinese government isn't focused on that right now. As long as the stock prices rise, they aren't too concerned about whether it's creating a bubble. After all this discussion, do you think there are any drawbacks to the central bank's stock market strategy? Consider this question. Banks have long provided stock pledge services, and many major shareholders use them to pledge their stocks. We frequently see that during major market declines, it's often the pledged stocks that trigger forced liquidations, leading brokers and banks to sell off shares aggressively, which worsens the downturn. Therefore, while stock pledges can help propel the market upward during bull runs, they also serve as amplifier during bear markets, intensifying sharp declines. Does the central bank's encouragement of stock pledges pose a risk of inflating a stock market bubble? The answer is likely yes. Anyone who has borrowed from a bank in China knows that whether through a mortgage or a personal loan, banks explicitly prohibit the use of those funds for investments in the stock or real estate market. If you do, it constitutes a loan default, allowing the bank to demand immediate repayment. These restrictions are designed to prevent excessive asset bubbles, whether in real estate or the stock market. The fallout from a bubble bursting can be devastating, and China has already faced this scenario numerous times. The central bank, of course, understands this well and wants borrowers to invest in the real economy, whether that means starting businesses, opening shops, renovating homes, or engaging in other forms of consumption. However, the current state of China's real economy is dire, and there is a lack of interest in borrowing from banks. To rapidly boost the GDP, the central bank has chosen to promote speculation in the stock market, stepping in as the main provider of stock pledges, effectively replacing commercial banks in this role. This approach is quite astute because the central bank's ability to absorb risk far exceeds that of any other financial institution. By becoming the largest stock pledge holder in China's A-share market, the central bank increases its stock holdings significantly. Although stocks are considered high-risk assets that could lower the quality of the central bank's assets, it doesn't worry about generating profit as it operates without profit motives. This allows the central bank to retain these stocks for as long as needed, avoiding the need to sell off to minimize losses, even if their values decline, as long as borrowers can cover their interest payments. The central bank is unlikely to pursue repayment regardless of the decline in the value of the pledged stocks. This, in turn, reduces the pressure on institutions and enables the stock market bubble to continue inflating. This is primarily a theoretical scenario, as asset bubbles ultimately face market corrections. If the central bank accumulates an excessive amount of stocks, the quality of its assets will significantly deteriorate. In the event of a stock market crash, the central bank may opt not to withdraw liquidity to support the market. Instead, it would need to inject additional liquidity, leading to an increase in the money supply. Ultimately, this situation could result in rampant money printing. At present, A-shares are essentially being propped up by the national team. This year, the market has managed to stay above 2,700 points mainly due to the rise in bank stocks, but this surge is disconnected from the actual economic fundamentals. If the bubble becomes too inflated, investors will naturally seek to exit, as everyone knows it's a bubble, while the national team can leverage the central bank's liquidity to buy up all the stocks that the retail investors and foreign capital abandon. Ultimately, A shares would be left solely in the hands of the national team, which would render the market quite dull, wouldn't it? Consequently, as long as A shares are in existence, they need to have both the retail investors and foreign capital. A healthy development of A share cannot solely depend on the central bank's liquidity injections. It requires enhancement to the underlying economic fundamentals. While the central bank may provide a temporary boost to A shares and increase GDP through policy measures, this should not be mistaken for a signal of an impending bull market. The trillions of yuan being infused into the market have minimal impact on the real economy, as major shareholders are focused on stock buybacks rather than using those funds to start new business, expand investments, or create additional jobs. Thus, it's crucial to acknowledge the risks involved in this speculative frenzy for ordinary Chinese citizens. Next year, Xi Jinping might change his KPIs and shift his focus away from GDP growth. If that happens, the central bank could quickly reverse its course and retract the support it provided today. Relying on the economic policies of a single individual introduces unpredictable and uncertain risks. In the end, Xi Jinping represents the most significant uncertainty in China's economy, as human behavior is inherently difficult to anticipate. Thank you so much for watching. If you find this video helpful, please like it, drop a comment below, and hit the subscribe button right here. It really helps YouTube suggest my video to others. I'll be back with more content soon. Until then, stay well.